All right, today we're going to talk about something that might just change the way you look at a market chart forever. We're diving deep into the real story behind chart patterns and something called institutional order flow. So let me just start with a pretty provocative question. What if all those patterns, the triangles, the head and shoulders, the flags you've spent hours, maybe even years memorizing, what if they're not really what you think they are? What if, and stick with me here, they're actually distracting you from what's really driving the market? So here's how we're going to break it all down. First, we'll talk about a very common problem, the trader's dilemma. Then we're going to pull back the curtain on the myth of chart patterns and figure out why patterns fail. From there, we'll get to the good stuff, uncovering the institutional footprint. And finally, we'll talk about following the big money. Okay, let's kick things off with a feeling I bet almost every trader out there knows all too well. It's that moment of pure frustration when you've done everything right, the pattern is perfect, and the market, well, it does the exact opposite of what the textbooks said it would do. I mean, we've all been there, right? You're studying the classics. You learn how to spot an ascending triangle, a bearish flag, that infamous head and shoulders pattern. These things become the very language you use to read the charts. It's the foundation of everything. But here's the thing. Here's the dilemma. If these patterns are supposedly so time-tested, so reliable, then why does trading often feel like a coin toss? Why do so many retail traders get completely burned out, feeling like they're just missing some secret piece of the puzzle? That's the real problem we're going to unpack. And that deep sense of frustration, it leads us directly to this central myth, this idea that's been passed down like gospel and technical analysis for decades. You know the belief. Chart patterns can predict the future. And you can see the appeal, right? In a world of chaos, they offer this comforting sense of control, a sense of predictability. And the promise is so seductive. If you can just master these shapes, you'll master the market. But what we're looking at today argues there is a critical, fundamental flaw in that whole way of thinking. So let's talk about why these patterns so often seem to fail us. The source material we're digging into makes a really bold claim. It says these common patterns we all learn, they don't actually have predictive power. They can show you what has already happened, sure, but they can't really explain why it's happening in the first place. And this right here, this is the absolute cheese shift in perspective. We were all taught that patterns predict what the price is going to do, but the reality is they just reflect moves that have already been put into motion by a much, much bigger force. You know, think of it this way. The pattern you see on the chart, that's not the signal. It's the echo of a signal that's already gone off. It's the effect, not the cause. It's the ripple from a huge stone that was dropped in the water by a deeper, mostly invisible force. So if the patterns we see are just echoes, then what's making the original sound? Well, this is where we start to uncover the real market mover. We're talking about the institutional footprint. And that invisible force has a name. Institutional order flow. We're talking about the colossal, overwhelming weight of buy and sell orders from the biggest players in the game, the banks, the hedge funds, the major financial institutions. Their enormous activity is what actually carves the landscape of the market. So in other words, when you're looking at a chart, you're not just looking at some abstract lines and shapes. You are literally looking at the footprints left behind by big money. Their massive orders are what create the support and resistance levels that those retail patterns eventually form around. This quote just nails the whole idea perfectly. It's all about a fundamental shift in where you put your focus. You need to stop chasing the shadows, which are the retail patterns, and start learning how to follow the footprint of the giant institutions that are casting those shadows. Okay, so this is all great information, but what do we actually do with it? How does this change anything? Well, this last part is all about turning this idea into a totally new, practical way of seeing the market. So here's the bottom line, the most crucial point. Your goal needs to change. It's not about memorizing a whole catalog of shapes anymore. It's about learning to read the story behind the chart, the story of where the big money is actually placing its bets. And it really comes down to a simple 3-step framework. First, you have to truly accept that patterns are the effect, not the cause. Second, you start training your eyes to look for the actual institutional footprint. Look for those big, sudden price moves from a key level, or areas where the market just slammed on the brakes and reversed. Those are your clues. And third, your entire strategy becomes about one thing: trading with that massive flow, not trying to fight it. So I'll leave you with one final thought, a question to ask yourself the next time you pull up a chart. Are you just watching the map that's already been drawn for you, or are you looking for clues about the powerful force that's drawing that map in real time?